Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by Buxton. You got to check them out. The mobile analytics you can do there are just completely awesome. We use it at our shop. You got to check it out. Go to buxtonco.com. Well, today we have a very interesting show. We're going to talk about the retail world. You know, a lot of people have thought that retail went through some struggles. It actually, for the most part, did really well. What about some of the larger properties? Well, you're in luck. We have Tom O'Hearn here. He is CEO and Director of Macerich. Now, they're one of the largest REITs in the retail world. They have properties in California, Pacific Northwest, Phoenix, Scottsdale. They have them from New York to Washington. They have 48 million square feet of properties, includes 44 regional town centers. So let's see what's going on in the retail world. Tom, sir, thank you for joining us, sir.
Thanks, Michael. Happy to be here.
Thank you. And so I think the first question our audience might have for you are, how are things going, especially with some of the bigger tenants?
Well, we're blessed. We have great markets and we have A-quality regional malls that we are in the midst of transitioning to town centers. So there's been a lot of great opportunities. Obviously, COVID slammed all retail, and we were no exception, particularly in some of our markets like California and New York. But the consumers come back strong, very resilient. Tenant sales are in excess of pre-COVID levels. We're at about 112% of what we were in 2019 during a comparable period. So the tenants are back, the consumers are back, and business is actually quite good. Leasing, I would describe the first half of the year as robust, which is amazing given the macro economy we're in right now. So the tenants have been back, probably more leasing activity than we've seen since 2015, which was kind of the high watermark coming out of the great financial crisis.
That's awesome to hear. And tell our listeners a little bit about converting malls to town center-oriented properties.
Well, it's interesting. I mean, the mall is constantly evolving, but we've seen changes in the last 10 years that were hard to imagine, before that. I mean, if we look at the kind of deals we're doing today, we're doing many different categories. We're doing co-working. Our favorite co-working tenant is Industrious. A lot of food and beverage, entertainment, think Round One, think Pinstripes, things that actually activate the property and bring a lot of traffic and people. Health and wellness, we're doing a lot of Lifetime Fitness clubs, which are a great addition and can bring as many as 4,000 to 6,000 people to the property a week. Those are kind of unique visits. We're putting office buildings on the adjacent properties next to our malls. We're doing hotels. The digitally native brands continue to be very active. Think Alo Yoga, Stance, Vori, Allbirds. EV makers find it very attractive, and that's not just Tesla. It's Polestar and Lucid, for example. I think we've got a Rivian deal or two that we're working on. And the traditional uses continue to come and open up space in our properties, tenants like Dick's Sporting Goods and Target. So it really helps to diversify our properties just away from what we think of as traditional retail, which was primarily apparel and footwear. And in fact, we're also adding multifamily to many of our properties. So really, it's a kind of a campus setting. It's mixed use. It's diversified, and it's a lot more interesting than the mall of 10 years ago.
Physically, on the actual buildings, is there a lot of demolition, or is there some bit of cutting into and using some of the existing facilities?
Well, there's both. I mean, each property is somewhat unique in and to itself. So, for example, we got back 9 Sears boxes. And for us, that created a lot of opportunities, but each location was different. There's a couple of properties, Los Cerritos Mall in California and Washington Square up in Portland, Oregon, where we're going to demolish the Sears box and replace that with mixed use. There'll be multifamily, there'll be entertainment, food and beverage, for example. So it's really given us the opportunity to reposition and reshape our properties.
That's great. And Tom, you guys are kind of in the middle of it, economy-wise, with seeing the traffic of the consumers, and then also talking and dealing with these larger retailers and other types of tenants. What are you seeing so far, and what are you hearing related to concerns about the economy and inflation and higher interest rates?
Well, look, we've been through a couple of very tough years, and the consumer has been through something they've never been through before, nor the retailers. At most, historically, a retailer would be closed 2 days a year, but during COVID, many were closed 3, 4, 5, 6 months. So it was really a unique and very difficult environment. So obviously, we've got uncertainty in the economic climate today, and from a macro standpoint. But most of our consumers and retailers are saying, even if we head into another recession, which is certainly quite possible, it will pale in comparison to what we all went through with COVID. The consumer's resilient. They're tired of being locked up at home. The retailers have said, hey, we had 2 years of putting things on hold. We're ready to open new stores. And, we're quite confident that we're going to weather whatever recession comes our way very well. And, you think about it, a typical recession, you'd lose a lot of the weak retailers. Well, the reality is we kind of had the great cleansing during COVID where we probably had 5 years worth of retail bankruptcies all happen within 6 months in 2020. So those tenants are no longer on the landscape. They're no longer a worry. And what we have left is the strong, growing, resilient retailers that are ready to continue their programs of expansion.
And here we are at the beginning of September, and so obviously the retailers are gearing up and for the holiday season. What are expectations there?
Well, it's always difficult to predict the holidays. Certainly we've got more question marks about the macro economy given inflation and interest rates today. But we like where we're positioned in terms of our A quality portfolio and the diversification we've added. So we think we'll weather the uncertainty well. We think the holiday season for us will be, good. And I think people are ready for it. People are ready to get out and get back to normal. We've been seeing that for the last 2 or 3 quarters, and we think that's going to carry on through the rest of the year.
Are the tenants having better luck getting products with the manufacturing and delivery of products from these other countries?
We don't hear too many supply chain issues anymore. The biggest complaint we hear is the labor force trying to get enough workers to come in and adequately staff their stores. That seems to be the biggest challenge for the retailers today. It's not so much supply chain issues that they faced in 2020 and 2021. They seem to be behind them. And if anything, the retailers are faced with having to more aggressively manage their inventories than they had to in the COVID years.
And you guys are obviously involved in a lot of construction. What are you seeing for trends there on labor and costs and material?
Well, costs had been going up clearly in 20 and 21, both raw materials as well as labor, but that seems to have subsided and slowed down a little bit. And it seems like our construction projects are a little bit more predictable than they were during 20 and 21.
That's interesting. So when you talk to tenants out there, your group talks to tenants, are they positive for the most part about where we are today? Look at the stock market just recently had some woes, and of course you mentioned inflation and other issues.
Well, as it relates to retailers taking new space, they don't tend to view operations quarter to quarter as an investor might, um, somebody investing into a retail company. So, to the extent there's a quarterly miss here or there, the street may get excited about it, but it doesn't really change the game plan for the real estate people at these various tenants. They know they've got to get X number of openings done in 22 and 23, and they stayed focused on that. So as I said, in the first half of the year, leasing was robust. The volumes were good. It was coming from a lot of different categories. We signed a record number of leases, the highest level we've seen since 2015. Now, could that slow down in the second half? That's possible, but we haven't really seen the signs of that yet. We'll see. But I think the retailers have realized, hey, we didn't do a lot of expansion, if any. We may have even contracted during COVID. Now it's time to get after it and get on with our expansion plan. And we're the beneficiary of that, as are the other A quality mall owners.
As a former CFO, helping the company and directing it to go public, and now CEO, you've been in the business a long time. Anything kind of surprising you or jump out to you right now that maybe people in the industry might not consider?
Well, I think, if you look at where the A quality malls are trading today, that's something people really aren't focused on. I mean, the dividend alone today for us is a 6% yield. And even though, we're trading at a pretty big discount, as most companies are today, given the economic uncertainty, it's an incredible buying opportunity. And you're getting paid a 6% dividend to wait out this downturn. We have great real estate. The cash flow is fantastic. We're throwing off about 250 million of free cash flow after the dividend, and that's capital we can use to pay down debt or redeploy into our projects. So that's the thing I think the street is missing, and a lot of individual investors are missing. Is it's a great buying opportunity today.
In the future of Macerich, more development, more acquisitions, dispositions. What are you guys doing?
Well, we've been pretty actively disposing of our lower quality portfolio since we came out of the financial crisis 10 years ago. And we take that capital and we redeploy it into the expansion and renovation of our existing properties. We've got 44 properties. I could see that potentially shrinking a little bit, in that we would redeploy that capital into our existing portfolio. So really what we're focused on today is diversifying and densifying the great properties that we already have. So I don't think we're going to be a big acquirer. We will do a few dispositions here and there, but I think our main focus is to densify and diversify the great assets we've already got.
Okay. And Tom, how about a tip for retail tenant reps or real estate departments of companies related to picking space and acquiring space and some of your properties and other landlords?
Well, I think, quality is always important as far as I'm concerned, whether you're on the landlord side or the tenant side. Get the best space you can in the best centers you can and develop a relationship with those landlords, because there's nothing better than repeat business on either side. Saves a lot of agony on negotiating the lease. You hash it out one time and you come up with something you can both live with, and you move forward with great real estate and good things are going to happen.
And Tom, are any of the tenants, any of the trends leaning toward tenants desiring shorter leases?
No, the thing that really pushes towards that, Michael, is if you have a tenant that's uncertain about investing capital in a space, and we may look at a situation and say, well, look, we're not going to go with a long-term lease if you're not willing to put some capital into your store. And that tends to be what pushes towards shorter-term leases. I would say we did a number of short-term leases during COVID. Now we're back to a more normal level of terms that are 5, 7, 10 years. But during 2021, first half of 22, some of the leases were shorter just due to some of the uncertainty that the tenants were facing.
Well, Tom, what would you leave our audience with to think about retail moving forward?
Well, when you hit a volatile market like this and there's a lot of negativity swirling, therein lies some great opportunities. I've been through this many times in the last 35 years I've been in this business. So look for the opportunities out there, and to the extent you can, take advantage of those opportunities.
Well said. Tom O'Hearn, thanks for joining us, sir.
Thank you, Michael. Appreciate it.
And
Take care, everyone.
Thank you. And thank you for joining us around the country. Please let us know what you think. Thank you for sharing the show. Thank you for subscribing and rating the show. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Buxton. Take leasing, site selection, and due diligence to the next level. Make the right decisions with on-demand mobile data. Visit buxtonco.com. By Bull Realty. For proven commercial real estate asset and occupancy solutions, contact me. My email is michael@bullrealty.com. By Commercial Agent Success. Expert level commercial real estate broker training. Cloud Access 1 up to 21 one-hour videos. Visit commercialagentsuccess.com. Thank you for reviewing, subscribing, and sharing America's Commercial Real Estate Show.